All right, we'll continue with futures contracts. Placing an order. How is it traded? Well, it's very simple. I, as a customer, place an order with my broker. My broker will transfer the order almost immediately through software to another broker, which is a member of the exchange. That broker will transfer the order to the pit. It will get executed on the pit, and from the pit we'll get confirmation to the floor broker, and the floor broker will confirm to the brokerage company, and the broker will confirm back to me. All right, everyone's busy with their thing. Okay? So, in general, for all futures, for stocks, for all financial markets, you have in general two types of systems. One is called bit trading, which is associated with open outcry, where people make the waves and they signal what they want to buy, what they want to sell, and how they execute. I will have a little bit of a video for you about that, so you can actually see what it is and what it looks like. And the alternative is an electronic system. In an electronic system, a computerized system matches the order. So you send an order to your broker, your broker transmits the order to the exchange. If it's a limit order, it will put it where it is. It's called in the limit stack. The order is waited to be executed. Or if it's a market order, it will immediately hit the bid or the ask, depending whether you want to buy or respectively want to sell. And that's how it gets executed. So it transmits from the customer. Usually the customer will either make a phone call. That's how it was in the old days. In the modern days, the customer will have a little software and a little program. You're going to log in the website, and the website's going to let you put in your order. You're going to say, well, what's the futures? What's the expiration? What is the symbol? And all the other details. Then you're going to say, confirm your order, and it's going to give gold contract 100 ounce expiration or delivery month of January, whatever it is at market, and all the other things. And when I hit submit order, usually within 1 or 2 seconds, especially if it's an electronic order, you're going to get a confirmation with the execution of the trade at what price you purchased. Okay. And here is the role of the clearinghouse. Let's see 8.2. What is it on 8.2? The role of the clearinghouse. Types of futures contracts. We're supposed to do this daily settlement. Daily settlement. I will see 8.2. Daily settlement example. Okay. The role of the clearinghouse is to settle trades. The main role of the clearinghouse is to be the counterparty to every other trade. Most students on the midterm incorrectly told me that the role of the clearinghouse is to match buyers with sellers. No, this is the role of the exchange. The role of the exchange and the pit is to match buyers with sellers. Okay, the clearinghouse is the counterparty. After the trade has executed and you got an open position, your open position is up against the clearinghouse. So the main role of the clearinghouse is to be the counterparty to all trades in the futures and to all trades in the options. So it becomes the counterparty. If it becomes the counterparty, the main function is to absorb or reduce counterparty risk by assuming itself counterparty risk. So, if you sell me a futures contract and I buy a futures contract, I'm not going to be assuming your risk and you're not going to assume my risk. I will assume the risk of the clearinghouse and you will assume the risk of the clearinghouse, okay? And the clearinghouse will have its own mechanisms to reduce the risk. The main mechanism through which the clearinghouse reduces risk is called settlement, and specifically daily settlement. In a daily settlement, whatever gains are made, you get the money posted in your account. And if you have any losses, your losses get posted in your account. So, if you have two accounts, let's say with $50,000 and there's a $5 gain, the one account is going to become 55 and the other one is going to become 45. Okay? So that's the daily settlement. Daily settlement is daily transfer of the gains and the losses. And the second defensive mechanism, besides the daily trading, is the margin call. Margin call is when you need to maintain certain amount of money in your contract, okay, in your account, up against a particular contract. Let's say you need to maintain $5,000 on a gold contract, okay? And if you go below $5,000, you get a margin call. Margin call means requirement by the exchange that you deposit extra money in your account against your contract. If you don't deposit, usually within 24 hours or whatever the time frame is, 48 hours, if you don't deposit the money, your account is liquidated, meaning your contract is sold out. So they're not going to wait so that you can say tomorrow, 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 tomorrow. That doesn't work with exchange. You got 48 hours. If you don't deliver 48 hours, the contract is sold at your loss. If you have enough money in the account, you take the loss. If you are below or you're in the negative, your broker takes the loss. Your broker will cover the loss for you, and then the broker will come after you to collect the difference, okay? So, by settling the accounts on a daily basis means that no one will skip their payments simply because, oh, you're losing money, pay more. If you don't pay more, you sold out, finish, okay? So, that's how simple it is. And the second defensive mechanism is the daily limit. If, for example, the minimum requirement for minimum margin for gold is $5,000, they will have the limit price on the downside so that you can't lose, let's say, more than $4,000 today. So when you lose up to $4,000, the trading will stop. And you lost only $4,000 for the day. Meaning they're going to limit your losses so that they're not requiring $5,000, but today you're losing $10,000, which means you're going to go in the negative. So with futures, as we said in chapter 1 long time ago, you can lose a lot more than what you initially invested. But if you keep losing, you have to give more money, give more money, give more money. And if you don't give more money, you get sold, okay? But you're not going to lose in one day twice more than the initial margin, because the margin itself is based on the volatility of the contract. If the contract is little volatile, the margin is going to be small. If the contract is 5 times more volatile, you're going to have 5 times bigger margin. So it is based on the volatility of the contract, so that 99.9% of the time, you won't be losing more money in one day than the contract itself. So, the main role is to maintain credit through margin deposits. Everybody's got to keep money at the clearinghouse. And if you fall below the threshold, you're out, you're sold, you're liquidated. All right, so I already mentioned the primary mechanism is called daily settlement. What does it mean? Daily means it happens every single trading day. At the end of every single trading day, there is a settlement. Settlement means transfer of money from the loser's account to the winner's account. So, you invested in gold, one contract, gold's up $10, you get extra $1,000 in your account. It's $10 times 100 ounces of gold. $1,000, you're up in your account. Whoever is short will be down in the account. So, you have initial margin. Initial margin is the amount of money that you need to have in your account in order to initiate the position, in order to have an open long or an open short. And I'm just going to pick some numbers, may not be quite correct. For gold, you need to have $5,000 in your account for the full gold contract. Okay? So, that's the minimum requirement. We call it the initial margin. If you have in your account 17,000, how many contracts you can buy? How many contracts you can buy? If you have 17,000, how many contracts you can buy? What's the maximum amount of contracts? Come on guys, this is math for engineers for little children. How much? How many contracts? Can you buy 7? Can you buy 12? How many contracts? What's Google say? How many contracts, guys? This is amazingly simple. You got 17 in cash, 17,000 in cash. You required a minimum of 5,000 per contract. Yeah, 3. You can buy 3 and you cannot buy 4. If you buy 3, you got an extra margin of 2,000. Okay? So, now you got the following. You bought a You bought a 1,200, okay? And you have, next one, maintenance margin of 3,000. 3,000 is the maintenance. Means if you fall below 3 margin, you gotta give money again, and you gotta raise it up to the initial, okay? So, if you fall below the maintenance margin, you gotta pay money. Alright, now let's do the daily settlement. Next day, you were very unlucky and the price dropped to 1190. 1190. So, your original balance was here, 17,000. Now, what's the daily settlement? What's your daily gain? What's your daily loss? What's your daily gain? What's your daily loss? What's the balance? You're down $10 on the day. What's your daily settlement? How much money you make or lose? Yeah, no. How much? This is for. Huh? How much money you lose today? You lose a lot or you lose little? How much you lose today? Hmm? $10 for, what 10 mean? 10 for what? What is 10? Yeah, $10, what does it mean $10?
Lose.
Yeah, well $10 for what? You mean for the whole day you lose $10? Oh, this is the price for 1 ounce. So how much is the loss for 1 contract? Oh, 1 contract. How much? How big is the contract? No, gold contract. Remember, gold contract is 100 ounces. Gold contract is 100 ounces. So your loss is 1,000 for what? Dollars for what?
70.
How much is your loss, guys? Come on, this is for babies mathematics. Yes. You lose here $10 per ounce. This is per ounce. 100 ounces is contract. This is your loss for contract. And you got 3 contracts. What's your total loss for the day?
3,000.
Minus 3,000. So what's your balance for the account? What's your balance for the account? Hmm? You're left with 14.
14,000.
Next one, you're lucky. You go to 1195. What's your daily settlement? How much you're up? Well, you're half. You're halfway over here. So, if you're halfway, so you're plus 1,500 and you're down to 15.5. And suddenly gold crashes on you and you're down to 1165. So, what happens now? 1165. Oh, you just lost 9,000. You just lost 9,000. And if you lost 9,000, you are down to 6,500. So now you got a margin call. First of all, what is the minimum required? What is the maintenance margin? What's the minimum that you must have before you get a margin call? What's the minimum you have to maintain? 3,000? Oh, 3,000 per contract. How many contracts? 3 contracts. So you need to maintain how much?
9,000.
9,000. So you fell below 9,000. You need a margin call. How much is the margin call? What's the margin call? What's the margin call? How much? How much money? They say,
2,500.
oh yeah, oh yeah, go ahead again. 8,500. Why? Why? To get, you need, once you get a margin call, you need to get back to the initial margin. So, you need to bring back 6.5, you need to bring back to 15. So you need to bring back to 15. This means that you need to put in a margin call of, what is it? 8,500. This means they say, send the money today. If you don't send the money today, well, they call it, what, 4 o'clock? Tomorrow morning when the market opens, you're out. Okay? It's that simple. In other words, you're down to 6,500. Tomorrow morning, yeah, you may lose 3, 4, 5, 6, even 7,000. And if you lose 7,000, the broker will be very, very, very happy to sell you out. You're going to lose everything. The broker is going to lose, if you lose 7,000, the broker is going to lose 500. But he's going to be very happy to sell you because you're out and you're no longer risk. And then he's going to call and say, look, you got to pay me back the 500, which you owe me. And if you want to trade again, you better put another 10 or another 15,000 with our account. Okay? So the broker is going to be in the morning very eager to sell your contract so that he doesn't go down to actually lose money from you. Is that fairly clear?
Yeah.
All right, so that's the maintenance margin. Maintenance margin is the minimum amount of money which you need to maintain per contract, okay? But if you get a margin call, okay, you need to bring it back to the original or initial margin. Okay. So, concept. Next one is settlement price. You should not confuse, and you saw, you should not confuse settlement price with last price. Last price is simply whatever traded last on the day. If the market closes at 4 o'clock p.m., last trade may be at 3:52, it may be at 3:57, it may be at 10 o'clock in the morning, okay? You may have only 8 contracts trading in the morning, and for 5 hours, nothing trades. The settlement price is usually, if the contract is very, very, very active, the last 4, 5, or the last 10 trades, or the average of all trades in the last 1 minute, or the last 10 trades bigger than whatever contracts, okay? So that's the settlement price. But if there was little trading or no trading, the settlement price will be calculated. For example, they'll calculate the price like this. And that's how it was actually done. They say, oh, right now the price is $11.50 on a very, very, very actively traded contract in December. Next December, the contract is also actively traded at $11.74. Okay, that's next December. So, what happens in February? They'll say, oh, in February, you got 2 months, and a difference of $24 for 1 year means $2 per month. So we're going to say February 11.54, April 11.58, and then April, May, June, it's going to be 62, July, August, 66. So we call this process extrapolation. And that's what they were doing with the gold contract over there. Okay? So you just extrapolate. Take 2 or 3 very active contracts, and then you get to extrapolate. You also extrapolate by knowing if you trade year after year after year, you know that the difference in gold is about, let's say, $1 per month. If it's oil, you know it's about 50 cents per month. Okay? So if you're a year out, you're going to be about $5, $6 more. Okay? So the settlement price, if the contract is not actively traded, will be calculated through extrapolation and knowing some previous data. All right. Variation margin, I honestly forgot what's variation margin. Variation margin, basically in the textbook, on my pages, on my textbook is 271. The variation margin is the money that needs to be required. This is the same as the margin call. So this margin call is known as variation margin. Variation margin is the additional funds that have to be deposited. They're officially due within a few days, but they're usually required to be deposited immediately. So all we did was calculate this 8,500 is the variation margin. How much money you need to put in to get back to the initial margin. Okay? Here they got an example at page 287. Let's see, on mine is 272, but because it's a bond and because they work very, very complicated, because you got to work with 30 seconds, 5 30 seconds, 7 30 seconds, and all these things, it's a lot easier to work with gold because gold is 100 ounces. For the exam or for the quiz, I'll give you with crude oil, because crude oil is 1,000 barrels of oil, okay? So, if you're 34 cents up, this means $340 up. If you're $3 up, $3 up per barrel translates to $3,000 per contract, okay? And I'll probably give you some more or less real prices on crude oil and what the prices are and what they were, and you gotta calculate the margin and the margin, the daily settlement, and it's very simple, it's very easy to calculate. You just got to remember how many contracts you have. So you multiply the daily price change by the number of barrels, the size of the contract, by the number of contracts. And if you hit the maintenance margin, you got a margin call, you got to calculate the variation margin. Alright, so usually in futures markets, for most of them, especially if it's not cash settled, you got a 3-day delivery process. In a 3-day delivery process, one day is called the position day. This is the day where you actually have the position open. If you're long, if you're short. In futures contracts, those that are short, and short means the obligation to deliver, they choose if they want to deliver and when they will deliver. Okay? So you may deliver over 1 month, remember? So they may choose to deliver on the 3rd, they may choose to deliver on the 5th, they may choose to deliver on the 21st, okay? So, you got a day which is called the position day. The next day is called the notice of intention day. The notice of intention day, you simply write on the exchanges, I have the intention to deliver tomorrow or the day after tomorrow, to deliver the day after tomorrow, the contract, and I'll deliver so many contracts, and this is where it is, and this is how I'm going to deliver. So you give it to the exchange. By the next day, the exchange will choose a long contract, and you say, hey, you're long, you have to buy. Give us money today, and so that you can get the commodity tomorrow. In other words, if you are long, and you're in the notice period, you risk at any point in time to be assigned to take delivery, okay? And you never know. You might get drawn by chance, okay? So, each exchange will have a mechanism of how to choose the long who will have to buy, okay? So, the mechanism, they may say, oh, the one with the largest position will have to buy. or the one with the oldest position will have to buy. Or they'll just draw a lottery, and there are 25 people with long positions, and they're just going to draw a lottery and say, number 7, you have to take delivery, okay? So, if you want to take delivery, you just stay. You don't sell your contract, and sooner or later, someone will be forced, whether they want or not, to sell to you. But if you don't want to take delivery, you want to sell your contract. You want to close your contract before notice day so that you don't take delivery that you can't take, okay? Or if by any chance the exchange will tell you, hey, you got to take delivery but you can't, they'll close your contract at the current price and they'll assign it to somebody else. And they'll keep closing contracts until somebody will take delivery, okay? So that's how it works, okay? And the last day, so the first day we call it position day. This is where you actually got an open contract. The next one is notice of intention. The short will notify the exchange. And the third one is called the delivery day. And usually this whole thing usually lasts about 3 days until you actually get for 1 day for the actual payment. Money's got to get transferred, and the goods got to get transferred to title. If it's oil, if it's gold, if it's rice, whatever it is. Okay. Usually delivery will specify alternative grades. Well, if you don't have grade A quality milk, or as you saw over there, grade 4 quality milk with 3.5 fat and all the other things, if your milk is grade 3, and if it's got 325 fat, you know, what's the adjustment? So, you will have clear definition of what else you can deliver instead of your original contract, okay? So, you may have 2 or 3 qualities of crude oil, 2 or 3 or 10 qualities of rice to deliver, okay? The exchange will specify a complete list of all acceptable qualities. So, when you're describing your contract for rice or for crude oil, you have to specify what's the type of rice and what is the acceptable quality that you can deliver, okay? Maybe you can't just deliver any kind of rice, okay? And then, you may have some offsetting to do. So, let me see what offsetting is, because I already forgot this whole offsetting thing. Okay, offsetting is simply closing out the contract. So, I am along a contract and I don't want to take delivery. When I sell the contract, selling the contract, so 1 long position and 1 short position doesn't mean 2 positions, means they're going to cancel each other out. So, offsetting is the cancellation of a long contract with a short contract. And you may also have exchange for physicals. This basically means that you got a long who wants to take delivery of crude oil because they use the crude oil. It's a gas station, for example, over here, and they want to take a lot of tons of crude oil. And you got some seller, and they got a contract, let's say 10 contracts. Well, they can get together and they can agree on what to exchange or what not to exchange, or what could be acceptable delivery to exchange. So say, okay, I can give you this, this, and this type of oil. I got this is what it is, and it's going to be good for 10 contracts. Okay. So the buyer and a seller could agree between themselves how to settle their contract with something that may be a little bit different from the standard deliverable stuff, okay? Because you may have a refinery, and the refinery will want certain oil. You may have an oil manufacturer, they got the oil, but the oil is not exactly what they want, but it's good enough, and they say, okay, you're going to give us a little bit more, a little bit less, whatever they agree on to settle the contract at whatever price they will agree. And there are a large number of forward market procedures, but a forward market will always specify, again, like the futures market, the exact procedure for delivery. So, futures markets usually have a very clear rules as to what it is. And it could be a long list, could be 5 or 10 pages of details. What's delivered, when, and how, by what time, where it is. There's gotta be a receipt, where it's stored, you know, how the receipt is transferred from one owner to another owner. So you need to understand what's the delivery, and part of your assignment is to describe the delivery of your underlying assets for the futures or for the options. All right, futures, price, and quotations. Better ones are from websites. Let me see if I got anything else. Yes, types of futures contracts. Yes. You get lots of futures types of contracts. If you went back to the website, you already saw right over here some types of contracts. You already saw agricultural contracts. You already saw energy, equity, forex, interest rates, metals. Separately you have over the counter, separately you have real estate, separately you have weather. So let's see a little bit of these. I mean, these are fairly straightforward. So, agricultural commodities. The big agricultural commodities are, as we already said, corn, wheat, rice. Okay? Wheat is big in Europe. Corn is in America. Rice is in Asia. Okay? Other agricultural commodities, and we already covered them, will be different animals. Hogs, pork bellies, okay? So, I mean, I can pull up the website and tell you a lot more, but anything which we generally use for food, okay? The agricultural will be in two main categories. The one main categories will be things that grow, and the other category will be animals. Okay, so we've got to be the vegetable category, things that grow, and the animal. Or sometimes they actually have them, you also call them grains. Okay, the big ones are grains. Now, grains are the preferred one for trading for one main reason. Grains first have a huge production, and second, they're easily storable. Grains store easily for many, many, many years. Example where it's very difficult to get trading is milk, because milk spoils extremely quickly. Just a few days and milk is almost gone. Okay, so milk is very difficult to trade because the quality may be different. It's got different number of microbes and all the other things. So milk quality varies and it's very perishable. A lot easier is to trade cheese. Cheese can last for many, many, many years. So agricultural. Let's see what else we got in here. Yes, here you got oranges and orange juice. You got cocoa. You got coffee. You have tea, okay? All of these are agricultural. Cotton, wool, wood. All right? The main characteristic of agricultural commodities is that they are very seasonal. You got seasons with huge supply, and sometimes the price will drop dramatically, and before the next season the price will rise steadily as you got a shortage, as you actually consume most of these. Agricultural commodities are generally consumed, as in eaten, right? So now, people may eat them if it's corn, but corn may be fed to animals like beef and cows, okay? So, next one is natural resources. And natural resources will be generally divided into metals and energy. And energy will be crude oil, it will be natural gas, it could be electricity. Of course, main one is coal, okay, so the resources from which you generate energy, okay? So these are natural resources. The other natural resources will be metals. And metals are divided into precious metals and base metals, okay? Furthermore, you got various other commodities, don't want to get into that. You got foreign currencies. The big foreign currencies are US dollars and a respective US dollar index, the European euro, the Japanese yen, now the bigger currencies becoming steadily the Chinese yuan, okay? And some of the other countries like Russian currency is getting a little bigger, the Brazilian real is getting a little bigger, okay? And still Norwegian kroner is fairly stable because of good, well-managed country. Next one, Treasury bills in euro dollars. These will be interest rate derivatives. And I'll be explaining there's a little bit of a difference between an interest rate derivative. In an interest rate derivative, the underlying is an interest rate. And here, these are fixed income derivatives. The underlying is actually a bond, a treasury bill, a treasury note, or a treasury bond. You also have equity derivatives, and equity derivatives fall in two main categories. One is the index, for the index, like the S&P index, and you saw the E-mini S&P, or the Dow Jones index, or some other index. And the other one is called single stock futures. Single stock futures, okay? And single stock futures usually means that one futures contract is for 100 contracts, for 100 contracts. Managed funds is technically not a futures contract. Managed fund is a little tricky. Let me see what we got over here. Managed fund is a little tricky. You have what will be called futures funds, and sometimes they're known as commodity funds. You have to differentiate between commodity futures and commodity funds. A commodity fund is a fund, it's an investment fund where the fund invests in commodity futures and commodity options. And they will not only invest, they will actively trade. And they make him buy and sell many times every day. So they're actively managed and actively trading managed funds. So these are known as commodity funds, okay? Then you have commodity pools. And a commodity pool is a very similar to a commodity fund. They are pretty much operate on the same principle, the same rule. The main difference is that the commodity fund is limited in size. People can invest in the fund until the fund reaches a certain size, and when the fund reaches the size, it is closed. If somebody want to sell, they can sell their share, someone else can want to buy, okay? But overall, the fund becomes fairly closed. Let's see two more. You got so-called contractor, whatever, don't want to do that. Let's do hedge funds. The main idea of a hedge fund is that it is an investment fund which is unregulated. It has pretty much no regulation. Participants in hedge funds must be what we call qualified. You gotta be rich, you gotta have certain sophistication, you gotta have a certain net wealth, and you gotta have a certain income. The hedge fund does not have to tell you where they invest, does not have to tell you what they invest. The hedge fund will usually take a lot of risks, so these are very risky investments. The hedge funds will be allowed and will be actively shorting when they believe it's going down. They'll be actively going long. Hedge funds will use a lot of leverage whenever they think it's appropriate, whenever they want to increase their risk. And hedge funds will be investing actively in derivatives. all sorts of derivatives. They can be investing in futures and in options and in swaps. And finally, hedge funds will be investing in all asset classes. They'll be investing in real estate, as well as currencies, in stocks, in bonds, in commodities, and on some of them they're going to be going long, on others they're going to be going short. In other words, hedge funds are completely free to do whatever they want to do, and usually they do it with huge amount of risks. And early on, hedge funds were making big piles of money, but later on we found that most of them lose money anyway. So mutual funds, we know that 20% of them make some money and 80% of them lose money. Well, early on, in the early days of hedge funds, 80% of hedge funds were making good profits and only 20% were losing money. And over time, as the hedge fund industry became more and more and more competitive, competition, we say, competed away the profits, and the profitability of hedge funds dropped, and those 10 or 15% who were smart, who were intelligent, who had alternative trading strategies, they could still maintain huge profits. And 70 or 80% of them usually lost money or significantly underperformed the market. And what happened is sometimes true. When the market is doing bad, a lot of the hedge funds are doing okay. And when the market is doing okay, most of the hedge funds are actually losing money. The biggest problem with hedge funds today is that hedge funds today talk to each other. You got 10,000 hedge funds, like thousands of hedge funds, and hedge funds have become one giant crowded trade. As soon as one or two hedge funds do something, the others begin to replicate it, and when few people trade on an idea, the idea is profitable. As soon as many hedge funds begin to trade the same idea from profitable turns to a losing idea. So, most hedge fund trading today is crowded trading, and most of them are on the losing side of the trade. And finally, you got options on futures. It's very simple. An option, again, will have a standard strike prices, okay? And the underlying deliverable will be a futures contract, okay? And it's simple as that. So, you're going to have June option, and usually the option, June option, which expires in June, will be on a contract, futures contract, with a delivery month of June 2. And usually the option trading will expire a couple of days before the futures contract. So, a couple of days before, the option will expire, the options will stop trading, you will get the delivery of the futures contract, and after a couple of days, the futures contract itself will stop trading too. Alright, 5-minute break, okay?